The market is now closed for Thursday, October 30th, 2025. Beyond Meat, ticker BYND, ended the session in a state of near total collapse, last seen trading intraday around $1.69 per share, a drop of almost 8% on the day. That move pushed it right back down toward its 52-week low, which isn't far from 50 cents. This wasn't just a bad day, it was the painful continuation of a violent unwinding, a return to a grim reality after a brief, manic flight of fantasy. But that 8% drop, as painful as it is for anyone still holding, is just a quiet tremor after the earthquake. To understand what is happening with Beyond Meat, you have to ignore the day-to-day chatter and look at the chart from the last 3 weeks. Just over 1 week ago, on October 22nd, this stock hit an intraday high of $7.69. The week before that, on October 16th, it was trading at 50 cents. This is not a chart that reflects a business. It's a chart that reflects a war zone. This isn't online investment, it's a casino. And the war is between a narrative of a food future that captured the world's imagination and the brutal, cold reality of a balance sheet that just exploded, forcing the company into a move that fundamentally altered its entire structure just to keep the lights on. This stock is, without a doubt, one of the most dangerous and volatile names on the market, a place where self-investing enthusiasts using platforms like the Robinhood app can get wiped out in a single session. The common story, the expectation that was sold to the public during its IPO, was that Beyond Meat was the next Apple stock of food. It was the clean, green, ESG-friendly protein that would replace the entire cattle industry, a story that felt perfect for a new generation of investors. The expectation was that revenue would grow to the sky, margins would expand as they scaled, and this company would become a blue-chip staple in every portfolio, from Fidelity mutual funds to aggressive growth ETFs. The reality, as we are seeing in late 2025, is that Beyond Meat is a low-margin manufacturing company burning through cash at an astonishing rate, facing collapsing demand in its core markets, and it just massively diluted its shareholders into oblivion to avoid a near-term bankruptcy. That recent 1,500% spike from 50 cents to over $7 wasn't a return to glory. It wasn't a sign that the business was fixed. It was a technical, brutal, and textbook short squeeze fueled by social media and targeting hedge funds. And as we can see from the price crashing back to $1.69, that squeeze is over. The bag holders are now being counted. Let's break down what just happened, because this is the entire story. The real story of Beyond Meat in 2025 isn't about burgers, it's about debt. The company was buckling under more than $1.1 billion in convertible notes that were due in 2027, with the company losing $30 million to $50 million per quarter, and revenues falling. There was no realistic path to paying that back. The market saw this, which is why the stock fell to 50 cents. So, in mid-October, management did the only thing it could. It executed a debt-for-equity swap. It exchanged that billion-dollar debt load for new shares, up to 326 million of them. To put that in perspective, the company only had about 76 million shares outstanding before this. It was a nearly fivefold increase in the share count, a catastrophic dilution that effectively wiped out existing shareholders. This was the trigger. The stock crashed 56% on October 13th when the market fully digested this. But this dilution also did something else. It created a technical powder keg. The short interest in Beyond Meat was astronomical, at one point reported to be over 80%, and by some measures from Ortex even exceeding 109% of the free float. This meant short sellers who borrow shares to sell them, betting the price will fall, were in a very crowded and dangerous trade. When the stock was at 50 cents, they were winning. But a wave of retail traders coordinating on social media saw the massive short interest and the newly cleared debt, even if it was at a high cost, and attacked. They piled in, creating a buying frenzy that saw trading volumes explode to over 476 million shares in a single day. This is more than 12 times the average. This volume, seen on platforms from SoFi Invest to the most sophisticated terminals at Interactive Brokers, forced the short sellers to buy back their borrowed shares at any price to cover their losses. This is the squeeze. It fed on itself, launching the stock from 50 cents to $7.69 in days. But a squeeze is not a business turnaround. It's a technical event. Once the shorts are covered, the buying pressure vanishes and the stock is left to trade on its actual fundamentals. And the fundamentals here are, to put it mildly, terrifying. The fundamentals are the reality that the squeeze expectation temporarily ignored. Beyond Meat is scheduled to report its third quarter 2025 earnings on November 4th. The company has already guided for Q3 revenue to be in the range of $68 million to $73 million. This is down from the $75 million it reported in Q2, which itself was a 19.6% decrease from the year before. This isn't a growth story like Nvidia stock. This is a story of contraction. The U.S. retail channel, its most important market, saw sales fall 26.7% in the second quarter. People are not buying the product in the grocery store. This isn't just a Beyond Meat problem. The entire plant-based meat category is struggling. Data from earlier in the year showed U.S. retail sales of plant-based meat fell 7.5%, with units down 10%. Retailers are actively reducing shelf space for these products because they're not selling. The expectation was that everyone wanted this. The reality is that in a world of high inflation, consumers are worried about price, taste, and a long list of artificial ingredients. They are opting for cheaper, more traditional forms of protein. The industry tailwind has become a brutal headwind. And then there are the margins. This is the part that long-term investors in Fidelity brokerage accounts should be most concerned about. In the second quarter, Beyond Meat's gross margin was just 11.5%, and that was down from 14.7% the prior year. In the first quarter of 2025, its gross margin was negative 1.5%. This means for a period of time, it was literally costing them more to make and ship the product than they were selling it for. And that's before paying for marketing, R&D, and corporate salaries. The company's loss from operations was $34.9 million in Q2 and a staggering $56.2 million in Q1. This is the cash burn that forced the dilution. The dilution saved them from an immediate liquidity crisis, but it hasn't solved the core problem. The business model itself is not profitable. The company even warned in its preliminary Q3 results about a non-cash impairment charge related to certain long-lived assets that is expected to be material. This often means they are writing off the value of factories or equipment that are no longer productive, another sign of a business in retreat, not one that is growing. This is the kind of high-risk, speculative name that a managed account like Schwab Intelligent Portfolios would likely underweight or avoid completely, as it behaves less like an investment and more like a lottery ticket. For those who are new to the name, what does Beyond Meat actually do? It was founded on the idea of creating plant-based proteins, burgers, sausages, and chicken that mimic the taste and texture of real meat. It uses a base of pea protein and other plant ingredients. The business is split between retail, selling in grocery stores, and food service, selling to restaurants. The expectation was that major chains like McDonald's and Yum Brands, KFC, Taco Bell, would roll out their products globally, creating a massive, stable revenue stream. The reality has been a series of small, limited tests that have largely fizzled out or failed to expand. The food service channel has been a huge disappointment. The business model is proving to be its anchor. It is a high-cost, R&D-heavy, capital-intensive manufacturing business that requires massive spending on marketing to convince consumers to try a product that is more expensive than its primary competitor, real meat. It's competing against commodity producers on one side and a slew of new, cheaper, plant-based private labels on the other. It's caught in the middle with a broken balance sheet. So, what is the future outlook here? This is where the expectation versus reality framework becomes critical for anyone practicing online investing. The risk is obvious. The cash burn continues. The dilution bought them time, but if they are still losing tens of millions of dollars every quarter, that new cash pile will dwindle. The demand in their core market is shrinking. The competition is fierce. The brand, once seen as a premium, is now associated with stock market chaos and financial distress. Another risk is the reverse split. With the stock trading under $2, it is in danger of being delisted from the Nasdaq. The company may be forced into a reverse stock split, which is almost always a sign of a company in deep, long-term trouble. The recent news of new products hitting Erewhon stores or expanding in Walmart